Welcome to the 129th season of the Canadian Club Toronto, Canada's podium. For over a century, this stage has united visionaries and leaders from politics, business, community, and the arts to share insights on the most pressing issues of our time. And with Canada in a pivotal moment, it's more important than ever that we come together.
We've been having important discussions and debates around this podium in this country for well over a century. I call this a historic podium of record.
Our club's always been a forum for visionaries, public figures, and decision makers to command attention to the issues of our time.
The Canadian Club is one of the most important podiums anywhere in the world that a Canadian can speak to, tell Canadians what it is that they think, develop those thoughts. So I want to thank you for that very, very much.
Please join me in thanking our esteemed panelists today.
Through our programs and events, including our youth and young leaders programs, our diversity partnerships, our joint events, and our media and social media opportunities, we offer you access to dynamic political, social, and business figures from abroad and right here at home.
The platform from which the eloquence of Canada has flowed all of that time, whether it be business, education, politics, sports, arts, and culture. If someone wants to say something to Canadians about this country and about the future of this country, this is the venue you choose.
Good morning, everyone, and a warm welcome to those joining us online. My name is Shazanne Chu, Canadian Club Toronto President and your host. Canada's financial sector faces a paradox. While stable and well-regulated, it remains concentrated with tremendous opportunity for productivity growth and innovation. Today, our guest of honor joins us to explore these important topics and how we can better support competition, modernization, and long-term economic resilience. Before I introduce her, I want to acknowledge that these civic-minded conversations are made possible by our partners and sponsors. Thank you to TD Bank, our sponsor today. We are grateful to our season sponsor, the Canadian Bankers Association, our official airline sponsor, Air Canada, and to Canada's Forest Trust, for helping us reduce our carbon footprint by planting smart forests in our honor. We're also pleased to welcome student tables from the Rotman School of Management. Where are you? Oh, back there, great. The York University Public Policy and Administration program as well. Where are you? Oh, right there, great. We're so glad you're here. Thank you. We also appreciate it when you post about our event, so I invite you to share today's conversation on your favorite social media channels. And I'm sure you'll have lots of questions about the future of our financial sector, so please use the question cards on your table and we'll share them with today's moderator. For those joining us remotely, please use the Submit a Question button that is on your screen, and our team will keep an eye out for them to hand to our moderator. Now it is my pleasure to introduce Carolyn Rogers, Senior Deputy Governor of the Bank of Canada. Since being appointed in 2021, Ms. Rogers has overseen the bank's strategic direction and operations, serving on the bank's governing council. Prior to her current appointment, she was Secretary General of the Basel Committee of Banking Supervision and served as Canada's Assistant Superintendent at OSFI. She brings deep expertise in financial stability, prudential regulation, and links between productivity and a resilient financial system. First, we'll hear from the Senior Deputy Governor, and then she'll be joined in conversation with Tanya Van Biesen, President and CEO of Versified, Board Director and immediate past President, Canadian Club Toronto. Tanya is a seasoned executive, board advisor, She spent her career at the intersection of leadership, governance, and economic growth. Carolyn, Canada's podium is yours.
Thank you, Shazan. Thank you to the Canada Club of Toronto. And thanks to all of you for being here. You're always glad when you're giving a speech that people show up, and I'm always particularly glad when it's a breakfast speech on a kind of cold fall day. And before I get started, how about those Jays? Go Canada. So I'm going to start today's speech back at another breakfast speech I gave last March in Halifax. And it was on Canada's urgent need to improve productivity. At that speech, I said that instead of thinking about productivity as some obscure economic statistic, we need to all think of it as a reflection of our collective ability to improve living standards, drive growth, and remain resilient in a fast-changing world. I also stressed that improving productivity in Canada is a shared responsibility, one that belongs to both the private and the public sector. That speech seemed to add a little fuel to a fire, a debate that's been going on for a long time in Canada about how to best shake off our productivity slump. About a year later, that debate took on even more urgency when a new U.S. administration implemented a series of trade policies that represent a massive economic shock to our economy. Meanwhile, Canadians are still grappling with a higher cost of living. Inflation's been back to the bank's target for about a year and a half, but life is more expensive than it was. And this is frustrating for everyone, and it's particularly stressful for people in lower income brackets and for young Canadians who are trying to get a start in life. Higher productivity won't make us immune to U.S. trade policy, but it would help buffer the effects of tariffs, and it's the clearest path to boosting real wages in Canada, making life feel just a bit more affordable. For businesses, higher productivity offsets rising input costs, helping to maintain margins and preserve price competitiveness, and a more productive economy is one that's more attractive to investors and to new trading partners. Bref, il était déjà urgent d'améliorer notre productivité, et c'est encore plus urgent maintenant. The bottom line, there was an urgency to improving our productivity before, and that urgency has only increased. So what's the holdup, you might ask? If productivity is so important and improving it is so urgent, why is it so hard to move the dial? The short answer is, like with most difficult problems, the solutions involve trade-offs. There's almost never a solution that has all of what you want and none of what you don't want. And like most policy trade-offs, views differ on the best way to balance them. Today, I want to illustrate this challenge by diving a bit deeper into one policy area that is critical to an economy's productivity, and that's competition. I'll lay out a bit of the economic theory on the relationship between competition and productivity, and I'll highlight very briefly what the research tells us. And I'll explain some of the trade-offs that emerge when you set out to improve competition in your economy. And I'm going to try and make this all a bit more real by talking about competition in a sector that the Bank of Canada pays a lot of attention to, and that's the financial sector. Now, the idea that competition can improve productivity is fairly intuitive. We seem to like our hockey analogies these days, so you could think of it this way. You always skate a bit harder in the game than you do in the practice, and when the puck drops, the tougher the competitor, the harder you skate. And the economic theory and the research on competition generally line up well with this intuition. Theory teaches us that competition works through a variety of channels. I'll name three. First, competition disciplines firms. It forces them to look for ways to reduce cost and inefficiency to make sure their business survives. Second, it encourages businesses to innovate so they can differentiate their product or service from other firms and get an edge. Third, competition leads to the reallocation of resources throughout the economy. Firms that are efficient and innovative attract more customers and more investment. Those that aren't will struggle to keep up and eventually exit the market. The result is that resources are continually allocated to their highest and most productive use. And research provides lots of empirical evidence to support this theory. Studies from Stats Canada, OECD, the IMF find that when markets become more competitive, whether through deregulation or trade liberalization or competition enforcement, firms tend to become more efficient, adopt technology faster, and innovate more. Firm-level studies reinforce this. The bank's own research highlights how important a dynamic business environment is to an economy's productivity. An environment where underperforming firms continually exit the market and resources are reallocated to new, more productive firms. Another insight from research is that for the overall economy, competition can matter more in some sectors than it does in others. For example, productivity gains in sectors that provide intermediate inputs to other sectors can lead to larger gains throughout the economy. This is particularly true in what we call network sectors, those that serve everyone. Think of telecommunications, energy, or transportation, for example. Canada's own Competition Bureau recently commissioned research in just this area, and the results are compelling. Competition also affects investment, another critical ingredient for productivity. If a market's highly concentrated, dominant firms may have the resources to invest, but they may lack the incentive to do so. On the other hand, too much competition in a sector can also lead firms to underinvest or cause market gaps. Think of sectors that require a big upfront investment or prolonged high levels of investment. Pharmaceuticals would be a good example here. The relationship between competition and investment is often illustrated with an upside-down U. Investment increases as markets become more competitive up to an optimal point. Beyond that optimal point, more competition can hinder investment as firms become less profitable and start to constrain resources. We also know competition can result in market distortions and disruptions. New entrants come in, they challenge incumbents, they put pressure on long-established business models. While this can benefit consumers, it can also introduce risks. Rapid innovation can outpace regulatory safeguards, leaving consumers exposed to fraud or to predatory practices. And often the gains from disruptive competition or innovation aren't evenly distributed, particularly in the short term. And this can leave vulnerable populations behind. Finally, there are markets where the public good is not well served by open competition. In markets where universal access is important or where public health and safety are at stake, innovation is still important, but disruption can be a problem. Most of us would agree that leaving things like our education or our healthcare entirely to open competition would not deliver the societal outcomes that we want. So, there you have the policy challenge. How to provide incentives to encourage competition while minimizing the disruptions that often come with it. An economy with too little competition will lag in innovation and efficiency, and it'll struggle to attract investment. An economy with too much competition can also have underinvestment, and it's also more likely to experience instability and market failures. Either way, it will damage productivity. Policymakers manage these trade-offs using a mix of legal, regulatory, and incentive-based tools. Competition law, for example, aims to keep the playing field level and reduce the abuse of market power. In industries like utilities or transportation where natural monopolies exist, regulation will be aimed at maintaining fair access and stable pricing. And where market forces alone may not be enough to attract or promote investment, incentive-based tools like tax policy, research grants, and protecting intellectual property are used. Now, of course, these tools have their own trade-offs, and their effectiveness can wane over time and distort markets as conditions change. New technology, innovation, and changing consumer preferences can upset competitive dynamics. Sometimes this takes years, sometimes it happens very suddenly. If policies designed to balance competition don't keep pace, they will create or exacerbate negative outcomes for consumers and for productivity. Now, that concludes the economics lesson. To make this all a little more relatable, I'd like to look at a sector of the Canadian economy that offers up a really good case study for many of the concepts and trade-offs I just described. The financial sector, and more specifically the banking sector, is a good example of a network sector that I described earlier. There's a big investment in shared infrastructure, and there's a network of players that compete and collaborate to deliver products and services. Almost everyone uses it, and it's critical to the smooth functioning of the economy. The banking sector facilitates the movement of money. It channels deposits into investments and loans that help businesses and the economy grow. So it's one of those sectors where gains in productivity should propagate to the rest of the economy. But it's also a sector where negative outcomes can also be magnified. So it's a sector where policymakers should regularly ask themselves if we've got the level of competition right. Have we got the right balance between safety and stability on one hand and innovation and growth on the other? Now, if you look at our track record, it would be hard to argue that Canada isn't delivering on the safety and stability objective. The last Canadian bank failed about 30 years ago. And since then, banking regulation has unquestionably tightened in Canada. There have been increases to capital and liquidity, there's been a bail-in framework created, and many improvements in supervision. The proof, though, is in the results. Canada's banking system has performed well through a number of major economic shocks, including the global financial crisis and more recently the pandemic. Now, it would also be hard to argue on any objective measure that Canada's banking sector is anything other than an oligopoly. The 6 largest banks collectively hold about 93% of all banking assets. To state the obvious, that's a very high level of concentration. Canada's big banks are also consistently more profitable than their peers in most advanced economies. Now, high levels of profitability and even concentration aren't necessarily all bad. Profitability contributes to stability. As a former bank regulator, I can tell you that a bank that gets behind on its earnings is more likely to take on extra risk to try to make up that ground. And the concentration of Canada's banking sector is often cited as one of the main contributing factors to its stability. The relatively small number of players means the competitive pressure to take on additional risk is less, and it also makes supervising that risk a bit easier. However, many argue that this level of concentration has clear negative impacts on productivity, on innovation, on capital allocation, and on cost and consumer choice. And in the current environment, the balance between stability and competition in the financial sector is part of a broader debate about how to get underperforming economies back into growth mode. The US has made several announcements aimed at reducing regulation in their financial sector. And earlier this year, Britain's Finance Minister Rachel Reeves called regulation a boot on the neck of business and told regulators that they should take up the call to not bend to caution and boldly regulate for growth. Now, The debate hasn't become quite that colorful here in Canada, but there are reasonable calls for reflection here too, and our regulators are listening. Canada's Superintendent of Financial Institutions says he sees room to tolerate a bit more risk in the system, particularly in the requirements for new entrants. And OSFI's been actively streamlining its rules, rescinding more than 20 regulatory guidelines just in the last year. Now, there are two important changes coming soon to Canada's financial sector that will help boost competition, and I want to take a minute to tell you about them. I'm going to start with a project called Real-Time Rail, which is a project designed to modernize our payment system. Canada is the only G7 country that doesn't have a real-time payment system. This means payments other than cash don't move directly from the sender's account into the receiver's account. You've probably noticed this. You pay a utility bill or make a payment on your credit card online, and you see the money come out of your account, but it doesn't show up in your utility account or on your credit card balance, maybe until the next day, sometimes even later. And that's because these payments currently settle on an overnight basis. Real-time rail will speed this up. It will allow businesses and consumers to move money directly and instantly any time of the day or night. And once it's in place, we'll be able to hook our fast payment system to those in other countries, which will make moving money across borders faster too. In addition to making payments faster, though, real-time rail will also make them more competitive by providing more companies with direct access to the payment system. Our current payment system, while we call it rails, I like to think of it as a highway that moves money around the economy. And that highway is currently restricted to a small number of regulated financial institutions. Other companies can only gain access to the highway by going through one of these other players. So, for example, if you're a technology firm and you've designed an application that makes payments faster or cheaper, before you can offer it to customers, you need to go find a bank partner that will give you access to the payments highway. And that partner will, of course, charge you for that service. Modernizing our payment system will allow more firms, including non-banks, to access the payments highway. Now, we need to ensure the highway remains safe and efficient, so firms that aren't regulated financial institutions need to register with the Bank of Canada and meet a core set of requirements under what's known as the Retail Payments Activities Act, the RPAA. The bank's role in supervising payment service providers under the RPAA started last month. Canada's real-time rail system is now in test mode, and it should be ready to launch late next year. It's been a long time in the works and suffered several delays, so it will be great to see it finally roll out. And the experience in other countries that have already introduced instant payment systems show that these systems have real economic benefits. And a study last year by the C.D. Howe Institute estimated that real-time rail could deliver more than $3 billion in efficiency gains to the Canadian economy in its first 5 years in operation. So this is one clear example of the productivity benefits that can come from more competition in a network sector. The second innovation in the works in Canada is open banking. In essence, open banking shifts control of your financial data from your bank to you. It creates a set of rules and standards that let you safely choose to share your data with other banks or with third parties, like a budgeting app, an investment platform, or a credit application. This has all kinds of potential uses, but one very important one is that it will make it easier to compare banks and to switch between them. Now, Canadians don't currently switch their banking relationship very often. A survey of 4,000 Canadians in 2020 found that only 6% had switched banking relationships in the previous year. And a more recent survey reported that 69% of Canadians haven't switched their primary bank in a decade, and 29% have never switched their primary banking relationship. Now, I'm willing to put some of this down to good service and satisfied customers, but not all. If you've ever tried to move your banking relationship, you will know it's fairly daunting. The hours of research, the reams of paperwork, missed payments, delayed deposits, and fees, lots of fees. So picture a future where you could load your banking data securely into an application that would research and recommend options for you to save money or get different products or services. You could then pick a new bank, have your data sent directly to that bank so they could use it to qualify you for the products and services that you want. All your credit history would be there. You're not starting from zero. Your new bank could then recreate all your automatic debits and credits so that your payroll would show up on time and your hydro bill and your car lease and your rent would all get paid on schedule. Now, combine open banking with real-time rail, and not only is all of this a lot more convenient, but it's faster, too. There's work to do, but this is a future within reach. The Canadian government first introduced the idea of open banking in its 2018 budget and put a legal framework in place called the Consumer-Driven Banking Act, which passed last June. Further legislation is needed to bring this idea to life, as well as regulations that obligate financial institutions to participate and minimum standards for other firms that want to be involved. Then technical standards need to be developed along with a supervisory regime that will maintain safeguards for consumer data and minimize the risk of fraud. Just like the payments highway, we want it to be open, but we need it to be safe. Real-time rail and open banking are two initiatives that promise to improve competition in a sector that is critical to Canada's economy and to its productivity. They need a final push to get them implemented, but the promise of more competition and greater productivity is on the horizon. Let me conclude with two messages for you to take away today. The first is Canada has a long track record of financial stability that we should all be proud of. We shouldn't take it for granted, but nor should we sit on it. The stability of our financial system is an asset we can use and a strength that affords us opportunities. Greater contestability, more new entrants, more innovation in our financial sector would lead to competition that's good for consumers, good for productivity, and good for our economy. We really should lean into it. There are important innovations on the doorstep, but we need to get them over the finish line. Second, as the world heads into a period of greater economic nationalism and more industrial policy, we need to resist the urge to add protections. Instead, we really need to look for ways to encourage more innovation and greater competition. I focused my remarks today on the financial sector because it fits with the Bank of Canada's mandate and with my own background. But there are other sectors in the Canadian economy where more competition would contribute to productivity and to growth. Getting rid of competitive protections between provinces is an obvious place to start, but it should not be where we end. We ought to think bigger than that. Thank you.
Carolyn, thank you.
Thank you.
This is a topic close to my heart. I will warn you, my eyes are watering, and at times I may be crying because of what we're going to talk about.
I think it's
Otherwise
that,
it
but
could
yeah, okay.
Thank you. Thank you for your remarks. And I will encourage everyone to jot down your questions. We will have people coming around the room to collect them, and we will do our best to reflect your questions through my questions.
Okay.
So let's just talk about productivity. You have talked about a productivity emergency in Canada. You talked about that last year. I think that was great because it did spur a lot of interesting discussion. You talked about some levers that we can pull on. Are there any others that you think we, not just the financial sector, but Canada writ large, all of our sectors, can pull on to advance our productivity?
Yeah, I mean, I think that's the point. There's not one big thing there's 100 little things we need to do. There's probably 5 or 10 big things, but there's 100 little things we can do. And often they're connected, so which is a good thing. It means it's a bit of a flywheel. As I talked about just in the speech, if you have competition, you usually have healthier business dynamism. You can attract more investment. Investment's critical for productivity. Your businesses are more motivated to train their employees, to invest in their business, to adopt technology. So there's a bunch of little things, but they're all connected. It's also really important, I think, to stress how much it's both a government policy and private sector. I often get asked, what needs to happen? What does the government need to do to make us more productive? And I mean, I think there are things the government needs to do. They need to create the conditions, but it is a joint responsibility. The government can set the conditions. Businesses need to invest to get to a more productive future for the economy.
I just want to double click on that for a second. What are we afraid of? Like, what do you think we are afraid of in this country?
Yeah,
or is that even the right articulation of the problem?
Yeah, I mean, this is, I think part of the problem is I think we're often compared to the US, which maybe isn't an entirely fair comparison. We have a lot of different structural differences in our economy. And then this topic of, is it something about the Canadian culture that holds us back? Or, I don't know. I mean, I do think we have probably been a bit complacent when you live next door to the biggest market in the world and you're rich with commodities that they need. And you've had an open and free trade agreement for years and years and years. Maybe we got a little complacent and relied too much on that relationship, but we got a big dose of reality recently. But it's a good question. I mean, I always reflect on one conversation I had. It was actually when I was in Halifax, and we were talking to a young woman who had a technology platform for education, and she said when she was trying to sell it in Canada, the first question she often gets is, has anybody in the US bought it yet? This is sort of seems like a backwards question to me.
Interesting. Interesting. So we're going to focus on the financial sector. Can you say a little bit more about the financial sector's role in improving our productivity growth, or indeed the things that maybe the sector is doing to constrain it? Talk about both sides of the...
Well, I mean, as I said, the financial sector in some sense is the plumbing of the economy. It moves money around. It channels savings into investments. So it's critical. And you want it to sort of be a smooth functioning. You don't want it to be sand in the gears of that system. So there's sort of two ways to think about it. Is as a sector, is it itself productive and competitive, and then is it enabling and productivity growth and investment across the economy? Made the point in my speech. I think we could invite some more competition in segments of our financial sector. But we need to do it carefully and thoughtfully. The fact that we have a very stable financial system, which, it needs to be contributed to a number of things, I should say, with our colleagues from the financial sector here. This is partly regulation. It's also partly a bunch of really well-managed firms that have managed their risk carefully and been good stewards of their organizations and of the Canadian economy. So I think the point I was trying to make is that should be something we see as a strength, not something that we should sort of guard and not be willing to change. So,
when we think about competition in the financial sector, inevitably the topic of fintechs comes up. So can you talk a little bit about, I mean, we have been slower to scale fintechs in this country than in other markets. What barriers do you see on that horizon, and what is the role, again, of regulators and incumbents to work together to accelerate that progress?
Yeah. Well, I mean, if you talk to fintechs, investment is something they'll tell you they need more of. But when it comes to regulation, I think one of the challenges is the way we're set up to regulate financial services in Canada is mostly entity-based. So you sort of define what kind of an entity you are. If you're a bank, you get a bank license from OSFI. If you're a credit union, you're provincially regulated. We don't really have a way to take a piece of banking and sort of a good regulatory regime for pieces of bank. We're on our way to solving that. The Retail Payments Activities Act was a good step forward. So now if you're a company that wants to offer payment systems and sort of become more competitive, more efficient in that area, you don't have to become a bank or be regulated like a bank just to offer sort of pieces of that value chain. So I think that will help. I think we have to get better at thinking about the activities versus the entities in how we regulate. And that puts us in a position to make a sort of more proportionate regulatory regime that's suited to the risk in that activity. So,
okay, interesting. We have a question here from the audience. How do we streamline regulation supervision to foster competition, especially for smaller players?
Yeah. Well, I mean, I think this is I mentioned in my speech, this is something that I think OSFI is giving lots of thought to. I'm not at OSFI anymore, so I'll just be careful. I can only speak at a high level to it. It's always a tough thing, this idea of proportionate regulation. You tend to design you're trained on one hand to be consistent, to treat everybody consistently and fairly, but then they also want to be treated proportionately, so it's always a balance. But I do think regulators around the world are turning their mind to this, and I know OSFI is for sure.
This is a bit of a different question. How important is the role of law firms in advising financial services, and what is something they can improve upon?
Oh, geez, you're right. That's a different one.
Yeah.
I don't know that I have much to say on that.
Do you want to call a friend on
that? Yeah. They're important. They should give good advice. Okay.
We did our best. No conversation these days would be complete without touching on AI. Mm-hmm. So can we talk a little bit about what you see the role of AI and digitalization playing in reshaping the Canadian financial sector?
Yeah. I mean, there was a really interesting report out yesterday about how banks are using AI and where and what they see as the return on that investment. I mean, what I think about, I've started using AI too, probably everybody in this room has, and when I think about financial stability, what strikes me is it just makes everything faster, and it sort of encourages you to take some shortcuts and do things quickly, and just instead of thinking something through or going and researching it, you type it in and say, okay, well, that's good enough, that's close enough. Mm-hmm. And I think that's good in many, many things. Like, it's going to make us more efficient. It's when you're delivering service, you know, it's a way for people who are delivering service to have all kinds of information at their fingertips. They can give you faster, better answers. But it's going to speed up bad things too. And having managed through financial crises or problems before, I can remember thinking, I just need everything to slow down so I can think. So AI will, I think, accelerate the good things, but it's got the potential to accelerate some of the bad things too. So we do worry about that. Digitization to me is a bit different. I mean, really what we've been dealing with sort of for the last few years is the sort of digitization of information and knowledge and stuff. The next frontier in banking is the digitization of assets. So you see the Genius Act in the U.S. designed to regulate stable coins. I think that's probably the next frontier. I didn't have room for it in the speech, but I do think we need to be thinking here about getting a framework in place for stable coin issuers and making sure, again, like not thinking about financial services so much as entities, but in terms of services. So yeah, tokenization of assets, digitization of assets, I think, is the next frontier, and we should be. Europe's got legislation, the U.S. has got legislation. We need to have our own framework here.
We have a question about stablecoin. How close do you think we are to regulation around stablecoin?
Well, I know the government is working on it, looking closely at what the U.S. and Europe have put in place. So I don't think we're far. I think they're all over it.
Okay. We have lots of questions. Also, not a complete picture if we did not go back to your opening comments about geopolitical tensions and the macro headwinds. So when you think about geopolitical fragmentation, rising protectionism, climate transition, how are you thinking about all of these things as you think about Canada's competitiveness, and what worries you most?
That's a huge question. I think the governor gave a really good speech on this a week or so ago. And I think his key message for the business community was an important one, which is what we're dealing with now is not a cycle. So this is not going to go away. Don't hold your breath and hide under the table and think, let me know when this is over and I'll go back to doing business. There's an enormous amount of uncertainty right now, and I think that's very understandably a difficult environment to invest in. But that probably is exactly what we need to do, is to sort of figure out how much of this uncertainty is sort of a permanent level of uncertainty that we're all going to live with for at least the foreseeable future. We've got a structural break in our economy. We're not going back to completely free trade with our largest trading partner. So we need to sort of reckon with that. And the only thing, if we don't figure out how to offset that structural change with a positive structural change, we are on a permanently lower path, which is not what we want. None of us want that. So I think, what we're trying to do, I think we were like everybody. We've spent the past 6 months. I mean, we would normally put out a projection every 3 months. We've been putting out scenarios. So we feel that uncertainty too. We've been doing business differently too as a result of that uncertainty. So we understand, but we're going back to a projection on our next monetary policy report. We need to move on. So.
Okay. I just want to recognize one of the students has put forward a question.
Oh, cool.
Given ongoing shifts in automation, AI, and labor markets, how can Canada ensure women are not left behind and are positioned to thrive in our economy?
Women? Or
women.
Oh,
yeah.
Okay. Interesting. I hadn't thought of those things as affecting genders very differently. I'm guessing the student is studying that, so that would be very interesting to talk to.
Don't know.
I do think some of this, some of the technology shifts combined with the ability to have a more flexible work environment post-pandemic has boosted labor force participation for women. So that's a really good sign. That tells me that some of those things have combined to make it easier for women to enter and to stay in the workforce. And that's a very positive thing in the Canadian economy. If you take that as a data point, it would suggest that these things are actually going to help women rather than things that we need to manage as a risk to women. But, yeah.
I think we have room for one last question, and I apologize if I wasn't able to get to everyone's questions, but if you could leave this room with one action item to move the dial on productivity and innovation, what would it be?
Yeah, I'd probably come back to the previous question. I'm from Ottawa, so I guess people often ask me, what's the government doing to help productivity? And I think this government is focused. We are seeing some big investments discussed, some big policy. In fact, I think the Minister Joly is going to be here later today to talk about industrial policy. So I think that's good. But I come back to the point that productivity and economic growth is a shared responsibility. It's the public sector and the private sector. The public sector can create the conditions. Our job is to create low, stable inflation. The government's job is to set the sort of fiscal environment, the policy environment, the tax environment, and then we need people in this room to do their job, to invest and to grow the economy. And I think if we all do our job, it's a bright future.
That is a great way to end. Thank you very much. Oh, geez.
Carolyn,
I was going to be on your lap.
on behalf of Canadian Club Toronto, thank you very much for such an insightful and practical conversation. Your perspective on productivity, competition, and innovation can strengthen Canada's financial sector and the broader economy. It gives us a lot to reflect upon. Thank you. Tanya, thank you for moderating with clarity and energy. It's always good to have you asking the questions. And a final thank you to our event sponsor, TD Bank. We also extend our thanks to our production partner, VBC Live, for expertly facilitating today's event. Before we close, a quick look at some upcoming events at Canadian Club Toronto. On October 20th, we welcome Nicole Butcher, President and CEO of Ontario Power Generation. On October 22nd, we host a panel conversation on Indigenous participation in project development in Canada with representatives from across the sector. And on October 27th, we're honored to host Mr. Victor Dodig as he reflects on his tenure as CEO of CIBC before his retirement. Please visit canadianclub.org for details to register, and members and guests, thank you for joining us this morning. We look forward to seeing you at a future event.